Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. The OPEC Plus cartel took everyone by surprise with the announcement to cut oil production by more than 1 million barrels a day. And on Monday, international oil prices recorded the biggest daily rise in nearly 1 year, stoking inflation fears. Brent oil futures soared to $82.11 per barrel by Tuesday afternoon. So will Indian consumers take a hit? And what about inflation? Pastor Kumar brings you the answers.
Is your daily drive to the office going to get costlier? If you are wondering why the question is being asked, let us quickly recap some recent events. In a surprise move on April 2nd, Saudi Arabia and other OPEC Plus oil producers announced voluntary cuts to their production of close to around 1.16 million barrels per day. The latest cuts, which start from May, come in addition to the 2 million BPD output cuts that OPEC Plus agreed to last October. Coming back to the original question, it appears that for now, this decision will not hit your wallet. Petrol and diesel prices were unchanged on April 4th, keeping costs steady for close to 10 months. The last countrywide change in fuel rates took place in May 2022, when excise duty on petrol and diesel was slashed. But what about the road ahead? Before we can answer that, we need to consider how India's energy mix has changed. Indian refiners, who rarely bought Russian oil before the Ukraine war, are now snapping up discounted Russian crude amid a slew of Western sanctions on it. Russia led the pack of crude suppliers to India in March, supplying twice as much as Iraq, once India's biggest supplier. The share of Russian oil in India's overall crude import basket jumped to 35% in the January-March 2023 period, from 16% for calendar year 2022. During the same period, the combined share of Iraq, Saudi Arabia, and UAE declined to 43%, from 50% in calendar year 2022. And analysts say that there is no reason to believe that Russian oil flows to India are temporary. India imports 85% of its crude oil needs. So, how will the latest OPEC cut affect oil prices as far as India is concerned?
If you were to look at the total consumption of India's requirement, probably by the end of this year, almost 35 to 40% of that basket will move towards Russian crude, right? If you kind of put this all together, if you assume, for example, that the international prices will be at somewhere close to that $90 per barrel range, then India will probably be keeping that same range. India will probably be closer to 80, 83, $84 per barrel.
But Indian consumers haven't gained from the supplies from Russia, which come at a significant discount to global prices. Pump prices of petrol and diesel have been unchanged for close to 10 months because Indian refiners have not been passing on these discounts to the consumer. Against this backdrop, how will the latest OPEC cut affect Indian consumers?
The pump prices will not change right now. That is what my sense is. As long as the price is between 80, 90, maybe even between 90 and 100, we will have a situation where the consumer will not be paying more, and the oil marketing companies will probably be taking the burden of this higher crude oil price. But maybe once we cross the mark of 100, then the government will be forced to probably increase the retail prices. Right now, we can work safely on the assumption will be between 80, 90, quite a bit of volatility in maybe 1 week or 10 days from now. And after that, I think we should reach an equilibrium, which will be in this region of 80 to 90.
It's unlikely that the government will allow the oil PSUs to be completely free on pricing. There will obviously be some sort of nudges which are kind of put in place. So we anticipate that if you were to look at the kind of gross margin that these companies are likely to play, if prices remain in that $90 kind of a range, it's very unlikely that there will be a significant price increase to the retail consumer in the short term, right?
While declining marginally from the January print, the retail inflation rate in February still remained above RBI's upper tolerance limit of 6% for a second consecutive month. In this context, what will be the effect of the OPEC cut?
What we were discussing all this time about the retail prices of fuel, as long as the government does not change it, I think whatever happens to the crude oil price will not be having an impact on inflation. This said, we have seen that the government has also been revising the prices of LPG, which is definitely not linked to the retail prices of petrol or diesel, which means that with the current run of prices of crude oil going up, there will be a case of our LPG prices to also go up, in which case the government has been passing on this burden to the consumer. There will definitely be an impact on inflation. But on the whole, I think if we're talking about a number like 6%, will the needle move much? Will it move to 6.5? The answer is no. Will it move to 6.1? Yes, possible, but nothing more serious than that.
Farmers will also not be squeezed in the absence of a surge in diesel prices. But things could have been better. The Indian basket was hovering in the range of $73 to $74 per barrel during the second half of March. This had brightened prospects of a cut in petrol and diesel prices. However, the industry has told news agencies that the latest OPEC cut will delay any revision in fuel prices in India.
With its economy reviving, our neighbor China is expected to import a record amount of crude oil this year. The country's leadership, it appears, is also taking a lenient approach to businesses now. Chinese billionaire Jack Ma recently visited the country after almost a year, and a day later he announced the corporate breakup of his e-commerce empire Alibaba, which was at the receiving end of Chinese authorities' ire in the last 2 years. So what's happening at Alibaba? Tariq Ahmed's report has the answer.
Jack Ma is back, and shares of Alibaba saw a sharp jump soon after its breakup announcement. The restructuring is reportedly aimed at offering more autonomy to its 6 new units, but the development is essentially seen as the government's softening of stance towards the Chinese tech major. Industry insiders believe this brings an end to the 2-year crackdown on Alibaba, which at its worst eroded 80% of its market value. Decentralization of Alibaba's businesses also addressed one of Beijing's key concerns, the concentration of power. Alibaba was founded in June 1999, which revolutionized the e-commerce landscape in China. It provided a domestic and international platform for Chinese MSMEs to sell their products. In 2003, Alibaba started its subsidiaries, Taobao Marketplace, Alimama.com, Links, and Alipay, later rebranded as Ant Financial Services or Ant Group. Within 3 years of inception, the company turned profitable and drove out its US competitor eBay Inc. from China in 2006. Alibaba's subsidiaries were highly successful and swiftly monopolized the Chinese market. Once a game changer in China's tech space, Alibaba and its co-founder Jack Ma had a great run till Chinese regulatory authorities began a crackdown on big techs. On 10 September 2019, Jack Ma stepped down and Daniel Zhang took over as a chief executive of Alibaba. The same month, the municipal government of Hangzhou announced the deployment of government officials in Alibaba for monitoring. Alibaba and Ant Group came under extreme scrutiny by the Chinese authorities in 2020. Ant Group's IPO, which was considered the biggest in the world, was halted by the government. In December 2020, Chinese regulators began an antitrust probe against Alibaba. 4 more authorities, including the People's Bank of China, started investigating the monopolistic practices of Alibaba and Ant Group. These setbacks crashed the market value of the company. So, why is Alibaba splitting itself into 6 different units now? Here's what Nirmalya Kumar and Sriram Subramanian have to say.
What is happening in Alibaba is very interesting because, of course, one can make a very rational explanation to it that it's a company that is in many different businesses, cloud, online retail, as well as entertainment, etc. So, and there's always a conglomerate discount and it's too big. And so by making it smaller and more focused, you're more likely to get the valuation release. Because remember, Alibaba today is trading at the same price that it was in 2014 when it was listed on the New York Stock Exchange. And if you look at Alibaba's PE, it's around 10 compared to its biggest competitor, Tencent, which is about 20. So there's clearly a valuation unlocking game that is to be played. But if you ask me personally, and if I was a betting man, what is the reason behind the impetus to split Alibaba? I don't think this is it. I think the real impetus is that Jack Ma had become the face of Chinese business. He was playing the role of God. And in 2020, this was all fine until 2020. In 2020, when he took on the financial regulators and started criticizing him, that's when the Chinese government decided, hey, these companies have become too big. We need to curb corporate power.
So if I look at it, the restructuring one will probably happen with different management and different sets of shareholders in each of these 6 companies. 2 is they can raise capital independent of each other. 3 is regulatory scrutiny for different businesses will be probably coming under different ministries in China, and there will be different oversight of regulators from the Chinese authorities. From a perspective of e-commerce may be much more open, whereas payment systems may be much more scrutinized, etc. So from that perspective, Alibaba can benefit with less regulatory scrutiny.
Does the restructuring announcement and Jack Ma's recent public appearance also mean that the Chinese government is putting an end to its crackdown on big tech companies?
The business environment in China for the tech companies over the last 3 years between the pandemic and the regulatory being out of favor with the regulation was a poor one. Now, what China has decided, pandemic is over, we are going to free the economy. And they've realized also that part of freeing the economy, part of getting the growth back is letting these tech businesses also free a bit. So their personal objective of keeping the tech entrepreneurs down and letting them know who's the boss has been achieved. Now they're telling them, okay, run your businesses. Because remember, a company like Alibaba or JD, hundreds of thousands of small Chinese entrepreneurs depend on these 2 companies to make their sales and their distribution. So actually, cracking down on JD or cracking down on Alibaba is not cracking down on JD and cracking down on Alibaba alone. It's also cracking down on the hundreds of thousands of Chinese entrepreneurs who use them as a vehicle for sales and distribution.
China is opening up its market now after zero COVID reversal. The recent developments indicate that the Chinese government is relaxing its policies to boost investors' confidence. It is important for China to set the big techs free as the majority of small and medium businesses in the country are dependent on them. Restructuring of the Alibaba group is also likely to insulate it from further regulatory scrutinies.
Back home in India, the energy sector is staring at a big change. More than a dozen gas pipelines that form a national grid have come under a unified tariff structure. And talks to implement the Kirit Parikh panel's pricing mechanism are also on. So where does the industry stand now and what is the outlook for related stocks? Harshita Singh brings a detailed report.
The Petroleum and Natural Gas Regulatory Board has brought over a dozen gas pipelines, which form the national gas grid, under a unified tariff structure from April 1. This will likely benefit customers transporting fuel over longer distances and multiple pipelines. Earlier, customers used to pay additional tariffs for using multiple and interconnected pipelines. Under the new regime, buyers will be charged a fixed tariff for the transport of gas over 3 zones, up from 2 earlier. A levelized unified gas tariff of Rs 73.9 per metric million British thermal unit or MMBTU has been implemented, which incorporates the recent hike in state-run GAIL's integrated pipeline tariff. Analysts expect GAIL to be the biggest beneficiary from the development, given a 45% jump in its tariff, while it could be slightly negative for city gas distribution or CGD companies.
The PNGRB hiked the integrated natural gas pipeline tariff for GAIL to Rs 58.61 per MMBTU with effect from April 1, 2023. This is 45% higher than the current tariff. PNGRB has considered total 10 pipelines as a single integrated entity. The hike was aimed at incentivizing GAIL to expand its pipeline network and improve connectivity between the gas-rich eastern region and demand centers in other parts of the country. With the tariff hike behind, volumes will be the key driver of growth for GAIL. It expects tariff increase will aid overall EBITDA by Rs 1,600 crores at current volumes, but the firm will appeal to PNGRB to revise it as the hike given to it is lower than what it expected. It is slightly negative for city gas distribution companies that use the pipeline network, as the hike could result in higher prices of compressed natural gas and piped natural gas for consumers. However, they could fully pass through the price increase to end customers over time. Top picks in the space currently are IGL, Gujarat Gas, and Oil India.
Novama Institutional Equities believes the impact of the unified tariff on CGD players will still be limited, as it constitutes just 2% of their selling price. According to Mahanagar Gas, passing on the cost could raise CNG prices by Rupee 1 per kg, though the company expects the impact to vary for players depending on their location. Meanwhile, the delay in implementation of the Kirit Parikh panel's gas price mechanism disappointed the street on Monday, which was expecting the new norm to kick in from April 1. At the Bosses on Monday, shares of IGL and MGL slumped up to 7% intraday as gas prices were left unchanged. Tuesday was market's holiday. The panel's pricing mechanism is expected to cap gas prices at relatively lower levels, which will significantly benefit CGDs in their margin recovery. Hence, investors are eyeing its implementation, which will remove a big overhang on the stocks. That said, CGD players are expected to have recorded firm margins in Q4 due to easing LNG prices. According to CLSA, IGL, Gujarat Gas and MGL should see strong margins in the January to March quarter, given a 50% fall in spot LNG price to $14 per MMBTU as compared to December. This has also led to a 2 to 3% monthly rebound in LNG demand, which will likely drive volume recovery for Gujarat State Petronet, Petronet LNG and GAIL. Today, the equity market will see global cues and keep an eye on the services PMI data.
Meanwhile, tech giant Apple is also expecting to usher in a new era. It is planning to launch its first mixed reality headset, which it sees as the start of a post-iPhone age. But what is this Apple's mixed reality headset? Udisha Srivastav brings you the answer.
Ever wondered how a 3D version of the iPhone's operating system would look like? Well, the world's biggest company by market capitalization has been working on such a technology for over 7 years now. Apple plans to invest most of 2023 in polishing this new device, a mixed reality headset. And it is likely to be launched in this financial year. This device is said to be a stepping stone for the company's long-term plan to replace iPhones with augmented reality sets. It is reportedly designed to offer the best of both worlds, the virtual reality and augmented reality experiences with features like eye tracking, hand tracking, and spatial audio. So far, several companies have tried their hands on making a mixed reality headset, but most of them failed to bring the best of the AR and VR. Even VR headsets haven't taken off as expected. Facebook too hasn't succeeded despite great efforts. Apple CEO Tim Cook recently said in an interview that the idea that you could overlay the physical world with things from the digital world could greatly enhance people's communication, people's connection. The team behind the Mixed Reality Initiative, Apple's technology development group, has been showing these sets of smart glasses to the top management since 2018. Inside the company, the device's operating system is called Borealis. However, it could be named XROS in the public domain. The device itself could possibly be named Reality Pro. According to Bloomberg's Mark Gurman, in 2017, Apple had the ambition to make the device publicly available by 2019. However, with delays in the rollout journey, the company first planned to make its headset available in the market in 2021 and then in 2022. The company later aimed to introduce the device in January 2023, which could be shipped later in the year. According to the last two updates, the company had aimed to unveil the product in June ahead of its annual Worldwide Developers Conference. But a top Apple analyst, Ming-Chi Kuo, later tweeted that the headset might be further delayed for mass production by 1 or 2 months to the mid to late third quarter of 2023. Even though the mixed reality headset may seem a likely looking opportunity, several company executives are concerned about the upcoming challenges. Gurman says the device may look like a dud standing next to the company's other existing products. However, he believes within a few months of its launch, the device has the possibility of becoming a market leader in mixed reality. Consumer interest is also likely to shoot as the device presents successive iterations and lowers its price point. One of Apple's last innovations was the wearable smartwatch. Thus, the company hopes that its new mixed reality headset might follow the same trajectory. Apple's smartwatch had picked up slowly in the market in the initial stages, but over time, the product struck a chord with customers after the company made improvisations.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But this mixed reality headset from Apple will reportedly come at a high cost. Some experts say that it may cost around $3,000 or 2,46,000 rupees. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.